Welcome. Today we are exploring why a crisis in New York can cause a market crash in Mumbai. This is called interconnectedness. At its core, it is the process of unifying different financial segments so that risk-adjusted returns eventually become similar across the board. In our modern globalized environment, markets like credit, forex, and derivatives are no longer isolated. They are coupled. This means when a financial earthquake happens in one part of the globe, it sends ripples, or a contagion effect, to every other corner of the world. Why is this happening now more than ever? There are four main drivers. First, capital mobility. Capital now flows across borders as nations look outward for savings. Second, technology. High-speed electronic systems mean that a price difference in two different cities disappears in milliseconds. Third, a shift in monetary policy. Central banks have moved away from strict quantitative controls toward using interest rates to signal market direction. Finally, harmonization. Countries are adopting similar rules and best practices, making it easier for global investors to trust and enter different markets. Integration happens at three distinct levels. At the domestic level, we see horizontal linkages. For example, a commercial bank acts as a bridge between your personal savings and a corporate loan. At the regional level, countries close to each other form ties to a central financial hub. Finally, there is global integration. This is the deepest level, where countries remove barriers like capital controls and taxes, allowing money and people to move across borders as if they were a single country. A perfect example of regional cooperation is the Asian Clearing Union, or ACU. Formed in 1974 during a time of resource constraints, it now includes 9 member nations, including India. The ACU is essentially a clearing house that allows these countries to settle their trade debts with each other on a net basis. Instead of paying for every single import immediately, they offset debits and credits. This saves precious foreign exchange reserves and makes regional trade significantly cheaper and faster. In India, the money market is the first leg of how government policy reaches the economy. When the RBI changes the repo rate, it impacts the call money rate, or WACR, almost immediately. Other market rates then evolve around this WACR. While global markets are volatile, the RBI often insulates the Indian money market from external shocks through liquidity management. If you look at the data, you'll notice that government bond yields almost always mirror the movement of the repo rate. Even though the money market reacts fast, the credit market, where you get your loans, is a bit slower. Because India is bank-dominated, bank lending rates are the most important part of policy transmission. However, pass-through isn't always perfect. Why? Banks often have rigid deposit prices, and they have to worry about asset quality or bad loans. Even with these delays, the repo rate eventually conditions the cost of funds for both wholesale and retail borrowers. Now, let's look at the capital market. Interestingly, stocks and bonds usually move in opposite directions. Think of it as a competition for your money. When bond yields go up, they become more attractive because they are safer. This increases the opportunity cost of holding risky stocks. If you can get 7% from a government bond, you'll demand much more from the stock market to justify the risk. However, while domestic stocks and bonds diverge, global stock markets are coupled. When the S&P 500 in the US moves, the Nifty in India usually follows. The stock market is also the biggest driver of the forex market. It works like a chain reaction. When the Indian stock market is booming, foreign investors pour money in, which strengthens the rupee. But if the market turns down, those same investors pull their money out. This requires converting rupees into dollars, which causes the rupee to depreciate. This negative correlation is a key reason why currency stability is so vital for a healthy stock market. Integration brings efficiency, but it also brings contagion. This is the virus of the financial world. It spreads through two channels, the real channel, which is a physical domino effect of trade losses, and the information channel, which is driven by pure panic and a lack of data. A classic example is the 2013 taper tantrum. When the US Federal Reserve simply hinted at reducing its bond buying program, the Indian rupee fell by over 16% in just 3 months. This shows that in an interconnected world, no market is truly safe from global shifts. Finally, how do banks handle all this? Through integrated treasury. In the past, banks kept their foreign exchange and domestic departments separate. Today, they are merged. This allows banks to manage their risks holistically. They can comply with reserves, manage their assets and liabilities, and even engage in arbitrage, buying an asset cheap in one market and selling it high in another. This integration is the final piece of the puzzle that keeps the modern banking system functioning in a world where everything is connected. Question number 1. What is the primary process of financial market integration? Option A. Separating market segments to reduce risk. Option B. Unifying markets to enable convergence of risk-adjusted returns. Option C. Increasing transaction costs to prevent volatility. Option D. Limiting the participation of foreign investors. Answer. Option B. Unifying markets to enable convergence of risk-adjusted returns. Question number 2. Which of the following is not a reason for the increasing interconnectedness of financial markets? Option A. Technological developments in electronic payments. Option B. Higher mobility of capital across national boundaries. Option C. Introduction of strict quantitative controls by central banks. Option D. Harmonization of global prudential regulations. Answer. Option C. Introduction of strict quantitative controls by central banks. Question number 3. At the domestic level, what does horizontal integration typically entail? Option A. Barriers between savings and loan markets. Option B. Linkages where intermediaries operate in multiple market segments simultaneously. Option C. Complete removal of capital account convertibility. Option D. Regional ties between two neighboring countries. Answer. Option B. Linkages where intermediaries operate in multiple market segments simultaneously. Question number 4. How many member countries currently make up the Asian Clearing Union, ACU? Option A. 7. Option B. 8. Option C. 9. Option D. 10. Answer. Option C. 9. Question number 5. In the Indian money market, which rate is considered the first leg of monetary policy transmission? Option A. Savings bank rate. Option B. WACR, weighted average call money rate. Option C. Corporate bond yield. Option D. Nifty 50 index. Answer. Option B. WACR, weighted average call money rate. Question number 6. Why do equity markets and bond yields typically move in opposite directions? Option A. Because they are positively correlated by nature. Option B. Due to the opportunity cost of investing in riskier assets. Option C. Because both are regulated by the same international body. Option D. There is no logical reason. It is a market anomaly. Answer. Option B. Due to the opportunity cost of investing in riskier assets. Question number 7. What is the information channel in the context of the contagion effect? Option A. Physical trade links between two companies. Option B. Direct exposure of participants in different segments. Option C. Panic withdrawals caused by a lack of accurate and timely information. Option D. The use of high-speed fiber optic cables for trading. Answer. Option C. Panic withdrawals caused by a lack of accurate and timely information. Question number 8. Which major event in 2013 led to a 16.6% fall in the value of the Indian rupee? Option A. The global financial crisis. Option B. The Southeast Asian currency crisis. Option C. The taper tantrum, US Fed reduction in bond purchases. Option D. The establishment of the Asian Clearing Union. Answer. Option C. The taper tantrum, US Fed reduction in bond purchases. Question number 9. What is the main objective of integrated treasury operations in banks? Option A. To keep forex and domestic dealing rooms separate. Option B. To focus solely on merchant transactions. Option C. To take a holistic approach to funding the balance sheet and managing risk. Option D. To eliminate the need for CRR and SLR compliance. Answer. Option C. To take a holistic approach to funding the balance sheet and managing risk. Question number 10. Which of the following markets is usually the most liquid? Option A. Capital market, bonds. Option B. Credit market, loans. Option C. Money market instruments. Option D. Insurance and pension funds. Answer: Option C. Money market instruments.